So quantum of coverage that you may have on non-lending financials, and if that is something that falls within your ambit. And if not, you've spoken to us about large cap financials. What about the second tier? Is there some merit in trying to own them? A lot of people are saying that the valuations, for example, on an IndusInd, 1x book, if something happens on MFIs because the new RBI government might be relaxing the norms a little bit, a lot of those stocks could benefit as well. Any thoughts?
So on second tier, when we look at it, it's still better to stay with the secured lenders rather than the lenders who are more focused on the unsecured side.
Okay.
So there are players who have more than 95% exposure towards the secured lending in the second tier. And that would be the preferred bets, given that they are also available at reasonable valuations of 1.2, 1.3x. And when we look at it, in fact, for MFI in particular, what we gauged from the conference that we had last week, in fact, the pain is going to continue in 4Q as well. And we need to see in terms of 1Q, the implementation of MFIN 2.0 guardrails, how much is the disruption. So no doubt, a lot of pain has already got recognized, provided for. To that extent, it might come off, but still they are not out of the woods. Okay, so to that extent, maybe rather. And on the unsecured side, when we look at it on the personal loans, we are seeing some pain to cool off. But on the secured, there doesn't seem to be too much of worry even on the asset quality side. And they might be able to participate on the growth as well. So would prefer more of a secured lenders compared to maybe the players who have exposure to the unsecured ones.
And still the pecking order will be large cap financials, and then maybe the second tier secured lenders.
Second tier,
and then the unsecured ones, if at all. Okay, fine. Perfect. Thanks for that. The final word, and the big idea for 2025, did China set it up in January itself? DeepSeek. And the flutter that is brought about in the AI world. What have you thought about it? Because you look at tech so closely. Sadly, we haven't even spoken about Capgemini and the impact that it had on Indian IT. Today, IT sector is down as well, etc. But just a brief on IT and DeepSeek before we wrap up.
Sure. And before that, I think like on the market outlook, one of the points I missed out is that the weightage of FIIs versus the emerging market benchmark is the underweight is among the highest in the last 20 years. Okay, so the positioning from a FII perspective is also the lightest that we have seen in a long, long time.
And typically, does that bring about a change? I mean, is that a cue at times, Surendra?
Again, India historically has mostly been overweight. Of course, the benchmark weight has gone up. But like compared to, say, a year back, when there was a big overweight, today there is a significant underweight. And that, to that extent, at least from an ownership perspective, it's definitely light, and that helps, of course, flows are very difficult to predict, but it kind of provides a relatively more favorable kind of a setup going forward.
Got it.
Now, on your question on tech, again, DeepSeek, obviously, I'm not an expert. The only point I would make is, rather than commenting on DeepSeek, I think open source models in general could kind of change things very meaningfully. Right, everything, right? The capex and the cost of compute, everything can change. And how it really impacts IT spending of clients, does it free up some room for growth in some of the other areas of tech? I think a lot of those questions are a debate right now. Still too early, there is a fair bit of debate on the topic. So we'll really have to see how this plays out going forward. On IT services, again, very factually, I think the guidance yesterday was below what the market was or consensus was expecting in Europe, and which is why there was a bit of a disappointment. But in IT, what we have been saying, like at least for Indian IT, is we see a very moderate improvement in growth in FY26, and valuations in that context are still on the higher side, right? If you look at this year, all the companies we cover put together, the growth should be around 4%, FY25. Next year, it's 5.5%, 6%. So that's still a very slow recovery. And for that, the IT index is trading at maybe 28, 29 times 1 year forward. And that has been our bigger concern on these stocks. And that concern still remains.